This is the Asia Trade. I'm Shery in Tokyo.
And I'm Paul Allen in Sydney. The top stories this hour. Asian markets set for early gains after a rally in chip makers drives US stocks to a fresh record high. Nvidia surging past Microsoft to become the world's most valuable company. North Korea hailing a new phase of relations with Russia as Kim Jong-un warmly welcomes Vladimir Putin to Pyongyang. Plus, Japan's Norinchukin Bank planning a $63 billion bond sale to stem the bleeding from bad bets on interest rates. All right, let's get to today's agenda. I want to start off with Nvidia, Shery. Wow, in a word, we have a world's most valuable company closing at $135.58 a share. That's a 3.5% rise, gives Nvidia a market cap now of $3.3 trillion. And of course, this is on demand for those chips which are used in AI, particularly the H100 accelerators. And to anyone who bought shares when Nvidia listed in 1999, well done. Your investment's up more than 591,000%. That's just extraordinary numbers, Shery.
And making founder CEO Jensen Huang really rich with that rally, right? But it's been that narrow rally in the U.S. markets that's really taken investors' attention right now, because we're talking about the Magnificent Seven taking up, more than 60% of returns of the S&P 500. So if you take a look at how U.S. futures are trading at the moment, we, of course, saw U.S. stocks see another record high for the S&P 500. We're talking about the highest on record for the 31st time this year already. And Nasdaq 100 futures still pointing to the upside of 0.1%, as investors were also really digesting those economic numbers, right? Retail sales data just rose, but marginally 0.1% month on month. Really, households taking a hit from rising prices. And despite the struggles of consumers and consumer sentiment, which has plunged, Fed officials seem to really be sticking to that higher for longer narrative. Take a listen.
I believe economic conditions are indeed moving in the right direction. If the economy evolves as I expect, it would become appropriate to begin easing policy sometime later this year.
Take a look at the setup across Asia, because we now have the FOMC, the ECB, BOJ, and also the RBA out of the way. We had seen the RBA stay on hold at that 12-year high, but at the same time, we heard from Governor Bullock that they actually discussed a rate hike and not a cut. So we saw Aussie dollar, Aussie bonds gaining ground in the previous session. We are seeing Sydney futures not doing much, as Nikkei futures also pretty much unchanged. But we've been watching the Japanese yen, because we saw a little bit of strength after Governor Ueda's comments in Parliament, where he talked about the potential of a rate hike in July coming simultaneously with those reductions of debt purchases, Paul. So we are really looking forward to more central bank movement, as we await data as well today from Japan trade numbers out within the hour.
Well, let's get some more market insight now with our first guest, Sylvia Jablonski. She's CEO and CIO at Defiance ETFs. And Sylvia, I've got to start with Nvidia. Just an extraordinary story there over the past quarter century, and now the world's most valuable company at $3.3 trillion. And at $135.58 a share, still cheaper than Microsoft and Apple. So do you buy?
Yeah, what a run Nvidia has had. It's certainly, delivered this year and to your point, over the last 2 decades or so. And I would be a buyer here. I tend to like dips, and I tend to like buying on dips, and eventually we're going to get one. I don't know that it's going to be this month, but it might be in coming months around the election and things like this. So if you haven't gotten in, there will certainly be an opportunity to get in. But that being said, not being an exact market timer, I think after the split here with the price where it is, the earnings delivering, the continued demand and outlook for AI, quantum computing, supercomputing, all of these things, it's never a bad idea to buy Nvidia, at least not in the near term, and probably not for the next 5 years or so.
Yeah, the AI story is such a dominant narrative at the moment, but to what degree do you think it's creating some distortions in the markets? Is that healthy? And if you want to get into the AI story, there are other names that you can be looking at upstream and downstream.
Yeah, that's a great point. So I think that everyone thinks of Nvidia as the only AI play out there. You certainly want exposure to that stock, but as Shery said in the introduction, just the mere fact that you own indices probably means that you have some kind of exposure to the Magnificent Seven and this stock anyway, right? In terms of what's next, we like to think about this in Defiance by looking at a broad range of securities that are part of the AI ecosystem. So yes, you want semiconductors, but you also want quantum computers. You also want data centers. You also want, 5G and connective tech, because all of these things are the staples and the building blocks for AI to actually grow and to come to fruition. And then you can think about, the other sectors that get impacted by AI. So, for example, healthcare. All of these companies that are coming out with these weight loss injections and things like that. AI data could help them come out with perhaps pills or kind of easier ways to administer drugs or more efficient ways to think about weight loss and curing cancer and things like this. And so, once those companies start to also monetize and use AI, you start seeing it feed into there. So I would kind of look at the broader inputs of what makes AI run for stock investments.
Sylvia, how concerned are you about the deteriorating consumer narrative in the U.S.? I mean, consumption is so important for that economy, and retail sales marginally rising, not to mention the consumer sentiment numbers are not really looking great these days.
Yeah, the consumer data is pretty interesting because on one hand you have, kind of falling sentiment, but on the other hand, you have consumers that continue to have strong wages and, spending is just marginally off, but it's relatively high. There are trillions of dollars of cash sitting on the sidelines that aren't actually in the market. And where you do actually see spending and growth is in the services and in the, experiences part of the market. So the hotels, the airlines, the cruise ships, the Taylor Swift concerts, things like this. I mean, people are certainly spending money in different parts of the market. So I think that the consumer is fine in a healthy spot. That doesn't apply to obviously everyone sitting at home and paying a lot of money for groceries. But when we're talking about kind of like the market and stocks and where we are, it does feel like we're getting that soft landing. Jobs are decent enough, but softenings are decent enough and starting to soften. Companies are, corporate growth is growing. Forward-looking earnings are projected to be double digits. And when we think about investing specifically, I don't think that right now the consumer is of great concern.
We're talking about hedging the concentration risk at this point when it comes to those tech names. Other than sector divergence within the U.S. economy, do you go elsewhere for that diversification?
Yeah. So to your point, I definitely look at some sector diversity within the U.S. for sure. Like the healthcare is a good one, right? Defensive play, dividends, things like this, aging, booming baby boomer population. But yeah, I look to places like China that haven't had the best run over the last couple of years. And you're starting to see things like supportive public policy, the government kind of buying stocks, easing of reserve requirements, sort of fiscal support with property, global reentry into China in terms of A, travel, but B, just globally investors are starting to reallocate to the market again. And you kind of get the larger economies following suit. And then, Japan as well, third largest economy. Japan has seen strength in the market outperforming the FTSE world most recently. And I think you have a good story there too. So a little bit of international diversification right now might go a long way.
We're expecting April trade numbers out of Japan, and the expectation is for another deficit given the weakness of the yen, which is now starting to weigh on the economy. Does that concern you at all?
It does in the near term, but I think that overall, when we look at Japan, you're seeing a bit of a turnaround story there. You're again starting to see. So what Japan has, I think that China doesn't have in its favor is sort of this lack of political issues and lack of fears around tariffs and trade wars and things like that in the future. So I do think that over time, that market tends to stabilize and you have a little bit less political risk there. So, I keep it in my basket there, regardless of kind of short-term hiccups. I think that long-term, it's a good place to be invested in the Japanese stock market.
All right, Sylvia Jablonski, CEO and CIO at Defiance ETFs. Thanks so much for joining us. Still to come on the Asia trade, we're going to speak to Barclays Global Head of Sustainable Finance about the challenges businesses are facing to achieve net zero targets. Plus, hear why JP Morgan Asset Management thinks Indian valuations look stretched. And a former Australian ambassador to China going to be joining us to discuss the warming relations between Beijing and Canberra. This is Bloomberg.
You're watching the Asia Trade. Russian President Vladimir Putin has arrived for his first visit to North Korea in 24 years after praising Kim Jong-un's regime for its support of his war in Ukraine. Our East Asia government editor John Herskovitz joins us now with the latest. And John, that was quite the hug at the airport with Kim Jong-un and Vladimir Putin.
Yeah, it's kind of unusual for Kim to go out to the airport, and this is only for the highest level of meetings. And this show of support, affection, it's just like, it's kind of like the very close relations that he has with Putin, which have gotten much, much closer since Russia launched its full-scale invasion of Ukraine.
Which has been really interesting, right? Because so far when we talk about North Korea, we've talked about that alignment with China and Beijing being the biggest backer. Have things changed now?
Yeah, we're seeing that Russia is providing a huge amount of aid in return for North Korea's supply of munitions for the war, for Russia's war in Ukraine. China's been North Korea's biggest benefactor for years, and it's a little bit on the outside looking in now. So we're seeing a little bit of shift now with aid from Russia playing a crucial part of North Korea's economy. China is always there. It's the bigger economic power. It's going to see a little bit of a change with this close relation with Russia and North Korea.
So in terms of the Korean Peninsula, does this change the security dynamic at all?
Well, what we have to find out is what Russia is giving to North Korea in return for the munitions. We're looking at things from tanks, technology, ways to develop its space program, to do spy satellites. So what North Korea gets that makes its military more potent changes the dynamics on the peninsula. And you have U.S. forces in South Korea and Japan who are there and are more vulnerable because of this. And North Korea also has missiles designed to hit the U.S. mainland and deliver nuclear weapons. Anything it gets from Russia that helps North Korea in these pursuits makes it more dangerous. Having
watched North Korea, China, and Russia for a very long time, what do you make of the Chinese side of things? Is this a good thing that North Korea is realigning a bit more closely with Russia? Because China also wants to pursue some economic interests elsewhere, right?
Yeah, and what we may see is that it benefits all three eventually, in that we'll have a stronger North Korea-Russia tie along with the already strong North Korea-China ties. And this triangular relationship is all in opposition to the U.S. and its partners. So we're seeing a more balanced triangle, and eventually this could really cause some problems for whatever administration is in Washington.
Yeah, of course, it gives more legitimacy as well to Kim Jong-un's regime. John Herskovitz, great to have you with us, East Asia government editor, on that visit by Vladimir Putin to North Korea. And of course, we're following what's happening with China as well, as the Biden administration is sending an envoy to Japan and the Netherlands seeking greater cooperation in limiting China's AI chip ambitions. For more, let's bring in our chief North Asia correspondent, Stephen Engel. And Steve, we're talking about this realignment when it comes to geopolitics across the region. What do we know about the latest when it comes to these technology advances that Beijing wants to achieve?
Well, obviously, China sees, their own domestic innovation and in chips for AI to be paramount importance, obviously because of those U.S. export controls that the Biden administration has been trying to influence as well. The countries like the Netherlands, which has the big chip making equipment maker, that's ASML, as well as in Japan, a staunch ally, of course, of the United States, which has Tokyo Electron, which also makes the equipment that makes those advanced chips. So those are the two two overwhelming leaders in the world that make specific equipment for advanced, processors for AI. The others, of course, in the United States are Lam Research and Applied Materials, which are under those controls. The problem is the Biden administration sees, yes, sort of compliance from the Dutch as well as the Japanese, but not necessarily on the servicing. And that's a big problem because, again, this equipment, including the extreme ultraviolet machines that are made by ASML as well as Tokyo Electron, they need constant servicing. So Alan Estevez, which is a Undersecretary for Commerce in the United States, is going to be heading to both Holland and Tokyo soon, probably in the first couple of weeks of July, to kind of talk to those governments to see what they can do to put a little bit more pressure on ASML as well as Tokyo Electron to specifically, according to sources, limit the export as well as the servicing of high bandwidth memory chips, which, again, Chinese companies like Huawei and others are starting to develop because these HBM chips are absolutely critical for these AI accelerators made by Nvidia and others. So, again, it's getting a little bit more technical and more specific in these controls. But, again, it's become, obviously, as you know, Shery, a big geopolitical issue as well.
And, Steve, we're also hearing there's a new legislation in the United States that might further limit China's semiconductor industry. What do we know of the details of this?
Well, obviously, we all know about the 2022 Chips and Science Act by the United States to basically get chip makers to invest in domestic chip making in the United States, like TSMC in its Arizona plants. And any company now, according to this new bill, bipartisan bill, which was introduced in Congress Tuesday, essentially would bar these companies that build facilities in the United States that take the money from the Chips and Science Act from using Chinese gear in those factories. It's just another step in the further control of that federal money going to the chip sector that's being invested in the United States. So Intel, whether it's Intel or whether it's TSMC, they will not, if this bill is passed and signed obviously by Biden, they would not be able to use Chinese equipment in those factories, in factories that are in the United States. It would not necessarily, according to this bill, apply to those companies' operations overseas. So TSMC and its factories in Taiwan or the new factories that are going online in Japan would not necessarily be under these controls by this new bill if it were passed.
All right, Chief North Asia correspondent Stephen Engel there. Other geopolitical developments that we're following. China is warning a bipartisan group of U.S. lawmakers not to meet with the Dalai Lama this week. Beijing has voiced strong concerns over the trip after the delegation arrived in the Indian town of Dharamsala. The group, including former House Speaker Nancy Pelosi, is set to hold talks with the Tibetan government in exile and meet with the Dalai Lama later on Wednesday. Israeli Prime Minister Benjamin Netanyahu is accusing the U.S. of withholding weapons for the war against Hamas. In a video statement, Netanyahu says he appreciates Washington's support, but finds it inconceivable that arms have been held back in the past months. While the U.S. has paused one shipment of large bombs, the White House denies any other weapons are being withheld. More ahead on the Asia Trade. This is Bloomberg.
You're watching the Asia Trade. Citigroup is putting its services business in the spotlight as a key component of the lender's restructuring and profitability plans. In an exclusive interview with Bloomberg, CFO Mark Mason lays out the bank's plan.
We want to be the preeminent bank for institutions with global needs, as well as a leader in global wealth and a winner in the U.S. market for our personal banking business. That's what we are today, all right? And a lot of what we talked about today, again, was really highlighting the crown jewel of our firm, the gateway to the rest of our offering for large institutional clients, but also for middle market clients, as well as for investors and asset managers in both that Treasury and Trade Solutions business, and our security services business.
It's interesting because, to your point, even though security services has been a crown jewel, accounting for roughly half the profit recently of Citigroup's own entire businesses, it's been hard to explain to investors exactly what it is, what it does. Do you think Citigroup stock would be trading higher if people understood the business prospects for it?
I think the services businesses, which are comprised of that Treasury and Trade Solutions and the security services business, contribute a significant amount of value to this franchise. And I hope that after today, investors will realize exactly how much value that is and how much upside there is to that franchise, and we start to see it in the stock price.
Today, you are seeing it in the stock price. If you think about some of the things that have been holding Citigroup behind, Mike Mayo of Wells Fargo, big proponent of Citigroup stock, but even he has been kind of critical here of the wealth business, calling the returns pitifully low. The question is, do you have a timeline for when investors can expect returns in that business, and how soon and how robust those returns can be?
You know, one of the things we talked about today is timeline. We talked about the medium term, 2026. We talked about top line growth of 4 to 5%. And we talked about the services businesses being a significant contributor to that, both in the top line, and our services business is a 20% return on tangible common equity. In the wealth space, we brought in new management there. And we're keenly focused on how we grow the top line and how we improve margins and how we improve returns there. That's going to involve everything from right-sizing the cost structure to increasing the banker productivity to driving new net investment assets across that business. And we do believe that inside of this window between now and 2026, you'll start to see that value play through our financials.
That's Citigroup CFO Mark Mason speaking exclusively with our colleague Sonali Basak. Well, Japan's Norinchukin Bank says it plans to sell about $63 billion in US and European sovereign bonds to staunch the bleeding from wrong-way bets on interest rates. The agricultural lender has confirmed it's now facing a net loss of almost $10 billion, and that's triple its previous forecast. The bond sales amount to almost 1/6 of the bank's global portfolio. Boeing CEO Dave Calhoun has faced severe criticism at a Senate hearing focused on the aircraft maker's safety record. It was his first public appearance before Congress since taking over at Boeing in early 2020. Senator Richard Blumenthal accused Boeing of focusing on profitability ahead of safety.
You and your board of directors have a duty to your shareholders, but they will be deeply ill-served if you fail to correct course to confront the root cause of this broken safety culture.
Nintendo has announced several new games for the Switch ahead of the expected launch next year of a new console. It's revealed a new Mario role-playing game and a fresh Zelda title that will star the iconic princess. The announcements suggest that most of Nintendo's development teams are focusing on the next Switch. IMAX has signed an agreement with Wanda Film to upgrade and add more screens in China, the company's second largest market by sales. CEO Rich Galfond says it will open as many as 25 new locations over the next 3 years and renew 100 existing sites. The expansion in China comes as Beijing gradually reopens its lucrative market to Hollywood films. All right, we have more ahead on the Age of Trade. Stay with us. This is Bloomberg.
This is the Asia Trade. We're about 30 minutes away from the major market opens. Here are the top stories that you should know right now. Asian markets set for early gains after rally in chip makers drive U.S. stocks to a fresh record high. Nvidia surging past Microsoft to become the world's most valuable company. The chip makers becoming one of the few companies to demonstrate significant revenue growth from AI. Russian President Vladimir Putin has arrived in North Korea for his first visit in 24 years after praising Kim Jong-un's regime for its support of his war in Ukraine. Kim personally greeted and hugged Putin as North Korean media hailed a new phase in relations between the two countries. And Chinese Premier Li Qiang is in Malaysia for a 3-day visit. The trip comes as Prime Minister Anwar Ibrahim says Malaysia will join the BRICS economic bloc, expanding a group seen challenging the Western-led global order. Let's get more on this with Bloomberg's Avril Hong in Singapore. And Avril, in a growing polarized environment here in Asia, how significant is this visit?
Yeah, I think it's significant in the sense that this is the Chinese premier, or the first time a Chinese premier is going to be visiting the Southeast Asian country since 2015. And it comes at a time when there's growing rivalry between the U.S. and China, and at a time when Beijing is courting some of these smaller nations that have asserted their neutrality, even in the face of such geopolitical tensions. So that's what's in play for China. For Malaysia, I think what's at stake is how it could go on to help deepen its ties with its largest trading partner, China. And even though Malaysia's economic recovery has accelerated recently, it could still really use the boost. We saw how Malaysia recently announced pledges for its own chip industry, and also announced some of these tech-related investment pledges from both U.S. and Chinese companies such as ByteDance, Google, Microsoft. And this is despite having political disagreements with Beijing over the South China Sea and with Washington over its handling of the Israel-Hamas conflict. Malaysia's leader, Anwar Ibrahim, has said that they don't want to get caught up in these U.S.-China tensions. For Malaysia, it's really about putting its own business interests first. And I think this visit is just part and parcel of how Anwar Ibrahim is seeking to balance relations with both the U.S. and China.
So, Ava, what else can we expect from this trip? Are we going to hear any announcements?
Yeah, as Shery was outlining earlier, we've already heard from the Premier Anwar Ibrahim ahead of the visit saying that Malaysia plans to join the BRICS economic bloc. But I think we are likely to see more in the way of Malaysia-China economic cooperation. And in terms of announcements, we're notably going to see the Chinese premier attending the groundbreaking ceremony of the East Coast railing. And this is worth noting because this is an $11 billion project that is part of China's Belt and Road Initiative, but it has seen stops and starts under previous Malaysian governments. It was suspended and then it resumed after renegotiations, which saw its costs come down quite considerably. So Li being at that groundbreaking ceremony is symbolic. In terms of other announcements, we're also expecting there to be the renewal of economic and trade pacts between Malaysia and China that include those for the industries such as robotics. Paul?
All right, Avril Hong there in Singapore. Well, before Premier Lee's Malaysia visit, he, of course, joined Australian Prime Minister Anthony Albanese in the Western Australian state capital of Perth. Now, that trip highlighted tensions over critical minerals supply. For more on this, let's bring in our metals and mining reporter, Paul Elaine Hunt in Melbourne. So, Paul, it's been an eventful trip. There were some unfortunate scenes in Canberra as well during the press conference between Li Qiang and Anthony Albanese, where the formerly detained journalist Chung Lei appeared to get blocked by members of the Chinese delegation, creating a viral moment. But if we look back on the trip as a whole, how would you characterise it?
It's gone well for both Australia and China. Let's not forget that two-way trade between Australia and China is valued at US $327 billion a year, or at least that's what it was last year. That's roughly 27% of Australia's total goods and services. As you mentioned, it was a whirlwind tour. Australian Prime Minister Anthony Albanese raised human rights, trade, obviously, maritime incidents happening in the South China Sea and contested waters of some of our neighbours. But Australia was added to China's visa-free travel list. There were additional MOUs signed around really important parts of our economy, including education and a strategic economic dialogue MOU that focused on policy settings, economic challenges and reform, fiscal policies and investment trends. So trade very much at the heart of this visit.
Yeah, Paul, and you mentioned the highlight on trade, but when it comes to actual Chinese investments into sensitive industries such as critical minerals, there's a lot of frustration there.
So this was one of those really interesting visits where Australia is trying to grow trade with China and find new opportunities to collaborate on different areas, but not so much in critical minerals. Now, China holds an absolute monopoly over lithium refining and of rare earths production and refining in that area too. Australia is attempting to grow its own downstream critical minerals production and refining for say, cathode batteries and really develop that industry. But it's in competition with China and it can't compete. Like I said, China's near monopoly on things like rare earths and lithium hydroxide is an area of pain for Australia, to the extent that just a couple of weeks ago, Australia's Treasurer Jim Chalmers ordered Chinese investors to divest their stocks or their shares in Northern Minerals, which is an ASX-listed rare earths producer and developer. So that was an area of tension between Australia and China, one which remains unresolved. That's despite 40% of the world's iron ore comes from Western Australia, which is exported to China.
And of course, primary among those iron ore exporters is Fortescue. Its biggest customer is China as well. Almost all of its iron ore goes there. And Premier Lee visited a Fortescue facility. Andrew Forrest, the chairman, made some comments there. What was talked about?
So, Andrew Forrest, as head of Fortescue Metals Group, Fortescue, has been very bullish in his approach for green hydrogen, a nascent industry thus far. It's very much a fledgling industry, rather. Green iron ore, and even as much Andrew Forrest talked about using green hydrogen for smelting and pig iron too. So, of course, Fortescue made a final investment decision on several $1 billion worth of green hydrogen projects just a year ago, and is producing some green hydrogen, but not really at a commercial scale. And certainly their project and their investments in green iron using green hydrogen are yet to be commercially ramped up.
All right, metals and mining reporter Paul Elaine Hunt there in Melbourne. We have more ahead on the Asia trade. This is Bloomberg.
You're watching the Asia Trade. Barclays says more money needs to go toward climate transition projects that are too advanced to interest venture capitalists, but not yet ready to attract the infrastructure investors. Our next guest calls it the missing middle of climate transition deals. Joining us now is Daniel Hanna, Global Head of Sustainable Finance at Barclays. Daniel, great to have you with us. So tell us a little bit more about what you mean by the missing middle and whether or not Barclays has so far been striking deals in that space.
Shery, well, first of all, great to be here this morning, and I'm really pleased to be back in Hong Kong where there is actually so much momentum that we're seeing in sustainable finance and ESG. Just to set a little bit of a scene, in the first quarter of this year, over half the transactions we've done in Asia were ESG labelled. We've mobilised more than $6 billion of financing. But I think, as you correctly point out, one of the things that I think we need to ask ourselves, if you like, as an industry, as we get lost between taxonomies and an alphabet soup of different definitions, are we driving real-world change? And one of the big gaps that we see is this missing middle of capital, where as we scale up the next wave of climate technology, there's quite a lot of capital at the sort of the venture stage. There's certainly a lot of dry powder at the infrastructure stage. But where there is this gap is as we scale technologies in between, so this missing middle. So at Barclays, we're trying to help accelerate companies through that. We've invested and are investing £500 million off our own balance sheet in early stage companies, whether that's hydrogen companies, carbon capture, vertical farming. And we're also aligning our bankers so that we can take them companies from an early stage space all the way to an IPO, like we helped with Nextracker last year, one of the most successful renewable IPOs on the NASDAQ.
As you're trying to strike those deals, what are you seeing in terms of appetite when it comes to transition investing?
Yeah, I think this area of transition finance is a really important one for Asia. I think we've seen a fair amount of agreement around what is green finance and huge amounts of momentum around that. But I think transition finance, i.e. helping sort of carbon-intensive companies decarbonize, is still a work in progress. And actually, Asia is really leading from the forefront here. We've seen Japan come out with a number of transition bonds, and in Hong Kong, where I am here today, the Hong Kong authorities have helped set out a sort of nascent transition taxonomy and are really, I think, being quite thoughtful about how do we scale this space. And this is actually one of the big topics that we're covering today in our conference. We've got a huge range of experts in Hong Kong coming together, including Dr. Daryl Chan, the Deputy CEO of the HKMA, and Ma Jun, who used to be the co-chair of the G20 Sustainable Finance Conference. And transition finance is very much one of the topics. The other two key ones for us are how do we help Asian companies grow and expand internationally. I was talking to a number of Indian CEOs just last week about the impact of the European cross-border carbon adjustment mechanism, and also how do we help them navigate the opportunities for things like the Inflation Reduction Act. I was actually in Houston a couple of weeks ago. And I think Asia's private offices also have a huge role to play and an opportunity in this scaling climate technology, and that's another theme that we hope to explore.
Daniel, can you talk to us a little bit about CO2 risk transfer as well? Is that something Barclays is considering, and if so, why, or if not, why not?
So, Paul, if you're talking about, I think we've seen a trade that's happened in the market around apparently some banks looking at how they report their own financed emissions and then involving in a trade where that risk transfer happens in the same way that we see sort of credit risk transfer, that CO2 risk transfer. I think at Barclays we're really focused around how do we support the companies that can scale through the next wave of these solutions. So trying to create this escalator of climate technology companies that can really help decarbonize these hard-to-abate sectors. And we've been very transparent in the way that we report our own financed emissions. We've set targets for 2025 and 2030 for energy, power, steel, aviation, a number of other areas as well. So I think we've got very transparent reporting around that, but our real focus is how do we mobilize capital that's going to unlock the next wave of climate change, climate technology, sorry.
Yeah, you're seeing any areas of new innovation in terms of that when it comes to sustainable finance-related products?
Oh, I think a huge amount of innovation. I think that's one of the really exciting things about this space. We did a really interesting social finance trade in India for the Indian vehicle structure. We've also seen a number of interesting transactions. For example, we did the first green use of proceeds equity raise last year for a US company. But it's really spending time with the entrepreneurs in this space that I think gives me a lot of confidence for the future. We did a round table with 4 companies, a couple that we've invested directly in, and a couple more that we've kind of supported across a range of different areas. And whether that's in the housing materials and how we can use AI and machine learning to optimize the amount of heating or sort of aircon required, or whether it's in food waste and how we optimize that as well. There is a really interesting amount of innovation in this space that I think if we can unlock and really drive, I think will help take out another set of issues. I mean, just to put a bit of context around that, if you look at the IEA's net zero scenario, 35% of the emissions reductions in the 2030s is anticipated to come from climate technology that's not yet scaled. So how we can really accelerate that, I think, is a really important topic globally, and of course in Asia as well, which has a significant vulnerability to climate change.
When it comes to those energy clients with high emissions, we have seen banks really at the forefront trying to pressure some of those clients to turn to do more so they can be treated as transition assets as well. Have you seen that change in terms of European banks having becoming stricter with these high emission clients, and whether or not what the response has been, I guess, is the question?
I mean, I think we set out our client transition framework last year and set out very much how we assess companies in the way that they are transitioning. And actually something that I spend quite a lot of time on is speaking to companies and sort of comparing them to their peer group and looking at what sort of best in class looks like. And then thinking, I think, hopefully quite constructively around how Barclays can help accelerate that process of transition. We now have 90 bankers focused around sort of energy transition and sustainable finance across the firm. And earlier this year, we brought together our climate technology companies, our energy company franchise, and our power franchise, all together under one roof, under Mike Cormier, to really think about how we can accelerate the work that happens across all those verticals in terms of the opportunity that we see for decarbonisation.
All right, Daniel Hanna, we'll have to leave it there. Thanks for joining us, though. Daniel is Global Head of Sustainable Finance at Barclays. Well, let's turn to electric vehicles now. China has slammed the EU's tariffs on its EV exports, saying the move undermines fair competition, openness and green development. Still, Beijing does remain confident that demand can keep on growing at a rapid pace, and Bloomberg's New Energy Finance Long-Term Outlook report supports that view. It sees EV adoption expanding at about 21% next year. Now, let's get more from BNF Intelligence mobility analyst Jihong Liu. Jihong, tell us more about these findings and what changed compared to the last Outlook report.
Yeah, thanks for having me. So the global passenger EV sales was 13.9 million last year, or roughly 18% of the total passenger vehicle sales globally. And in our latest long-term outlook, we expect the EV sales to reach 30 million by 2027, 42 million by 2030, and then 73 million by 2040. And in this year's edition, there are several new interesting findings, but I want to highlight a few here. And the first is the visible slowdown of EV growth across the globe at only 21% per year in the next 4 years, and that is compared to the high 61% per year in the past 4 years. But this has a geographic variation, significant geographic variation. For example, we still expect healthy growth in markets such as China, India, and Southeast Asia. But for some major auto markets such as the US, Germany, and Japan, we expect impacts such as policy uncertainty and lack of commitment to electric vehicles, and then a challenging economy, which will slow down our near-term outlook, and then also making the net zero target, 2050 net zero target, a bit more challenging. And the other one is the rise of plug-in hybrid vehicle sales. which has already seen a really high increase in terms of sales growth, 65% per year in the past 5 years, and the highest compared to all the other drivetrains, even including battery electric vehicles. And plug-in hybrid, they not only ease the range anxiety, but they also are sold at a comparable price, even as combustion cars in China, thanks to Chinese automakers BYD and Li Auto. That's why we raise the sales.
You mentioned range anxiety a little bit there. Tell us a little bit about that, because that was one of the original concerns for EVs, right? Are you going to run out of power in the middle of a desert? Are people traveling less in EVs, or how is this playing out?
Yeah, based on the data we collated, there seems to be less range anxiety, particularly in the leading EV markets. For example, in China and Netherlands, we see battery electric vehicles are driven 60% more than internal combustion cars, and this is largely driven by the high mileage working drivers, such as ride-hailing drivers. But this trend is not so obvious in less mature EV markets, such as the US, where battery electric vehicles were driven 40% less than combustion cars. But if EVs were still outdrive the combustion cars, then we will expect the quicker drop of road fuel demand and then more power demand.
BNEF Intelligence Mobility Analyst Jinheng Liu there, joining us from Shanghai as we get your trade data out of Japan. Breaking news: exports rising 13.5% year-on-year. This is a much faster acceleration for the month of May than was expected. It's also gaining by the most since 2022. When it comes to imports, it's growth of 9.5%. And of course, we've been watching the import data very closely because the weak yen has boosted the value of those imports, leading to a big trade deficit. Now, the trade deficit is coming in slightly lower than expectations, but we're still talking about a 1.22 trillion yen deficit when it comes to the month of May. We'll continue to watch those numbers and get you the latest on the BOJ minutes as well that are coming out right now. This is Bloomberg. And we're getting the latest lines when it comes to the BOJ minutes for the April meeting. Remember, that's the time when they kept the rates steady and simplified the language around bond buying. BOJ members saying that they will adjust the degree of easing if price trends rises. One BOJ member saying that they need to deepen discussions on rate hikes, that it will be necessary to raise rates in a timely manner. Another BOJ member saying the faster normalization pace is possible due to the yen. The market opens are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens as we continue to get the latest lines from the Bank of Japan. That's from the April meeting. Remember, there was no change when it comes to the rate, but we did see simplified language when it comes to bond buying. And also remember that press conference by Governor Ueda, which sent the yen to a fresh 34-year low. One BOJ member now saying the faster normalization pace is possible in Japan because of the Japanese yen. The Japanese yen, of course, has been very weak, which has helped Japanese exports. We got that trade data for the month of May. We got another trade deficit. But when it comes to the export numbers rising 13.5% year-on-year, beating expectations. Not surprising, the cheap yen making Japanese products more competitive. But take a look at the open right now, because we have seen that risk-on sentiment filtering in throughout the Asia session this week. We continue to see that upside of 0.5%. The Japanese yen unchanged has been really trading within a narrow range since the BOJ policy decision last week. Not a lot of change, not a lot of details when it comes to the reduction of bond buying, but we got a little bit of a spike in the Japanese yen against the U.S. dollar from Governor Ueda's comments in Parliament, keeping the door open to a possible rate hike in July, even with those debt purchase reductions. Take a look at the open in the Kospi, because we have seen those gains in the Korean stock market. We're watching geopolitical tensions as well, given that the Russian President Putin has arrived in North Korea for the first time in 24 years. We're seeing a little bit of strength for the Korean won, trading at that 1379 level. And of course, we're seeing the positivity filter through in the Asian session, with the Kospi gaining ground. Remember, Wall Street, another record high for the S&P 500. What is it this time? 31st all-time high of 2024. Nvidia contributing to those gains, becoming the world's largest company. Take a look at the open in Australia right now, because the RBA kept the rate steady at that 12-year high. But Governor Bullock saying the policymakers discussed the case for a rate hike at their meeting, not a cut. So we actually had the Aussie dollar, Aussie bond yields rising in the previous session. This is the picture right now as U.S. futures also remain steady. We, of course, are watching those record highs being achieved in the U.S. market. Let's get more, and our next guest is closely watching what's happening in Japan and South Korea. Aisa Ogoshi is Asia Equities Portfolio Manager at JP Morgan Asset Management and joins us now here in the studio in Tokyo. Aisa, great to see you in person.
Thanks for having me.
And you've been watching Japan and Korea, mostly because we're also seeing those reforms for the markets, right? But tell us a little bit about how the weaker Japanese yen is also powering some of those export names here in Tokyo.
Yeah, so definitely a positive for the exporters. Like autos, we've seen the strong outperformance over the past couple of years. But to be fair, the Japanese companies have diversified their manufacturing base. The weakening yen definitely helps, but we would like to see some floor in terms of the weakening trend, and that should then contribute more to the domestic economy.
That has been really interesting, because you talk to all of these Japanese companies, and because they have these production bases overseas, it sort of offsets the cheap yen.
Exactly. So having said that, capex demand is growing in domestic Japan as well, not just in semiconductors, but across the board in heavy industries. So again, we would like to see some rise in capex, as well as the stabilization of the yen would be a perfect combination.
Do you think if we see a faster acceleration of the weakness in the Japanese currency, it will eventually start hurting confidence in the markets?
It's difficult to tell. I think the market would like to see, again, stabilization. So a strong trend in either way is always creates volatility.
When it comes to the incredible rally that we've seen in the tech sector, especially in Wall Street, how much of that has translated to Asian equities?
Oh, a lot of it has translated to Asian equities. So when we look at semiconductors, when we look at the tech supply chain, it's basically all in Asia. So Taiwan, Korea, Japan as well. And we've seen strong rallies in all three tech sectors in these markets, and we expect that to continue. It's not just about Nvidia supply chain now. So we've seen Apple come out with new AI features that will trigger another round of filtering through to the beneficiaries of the smartphone supply chain.
We started this conversation with your optimism about corporate reform and governance in Japan and South Korea. How much of that optimism in some of these tech names can be sustained if we don't necessarily see real change? We have seen that optimism for Japan, but a lot of what has happened in Korea hasn't really lifted confidence in the markets.
So it's true for Korea, it's still early days. I think what's encouraging and what we learned from Japan is that unlike in the past when the pressure was mainly from the foreign investors, Japan has seen many domestic investors contributing to the improvement in corporate governance. And I think we are seeing the similar trends in Korea. For example, the National Pension Fund is also very keen to see more improvement in the corporate governance space.
When it comes to India, we've seen a lot of volatility, a lot of optimism as well, especially from Japanese investors. Retail investors have been looking at those India ETFs. Yes. What's surprising in your notes is that you're actually underweight. Why?
Yes, so it has been a painful period for us being underweight India, and we do understand the enthusiasm for growth, and we are optimistic on the growth prospects as well, but it's just the valuations are at extreme levels. So India currently trades well above 4 times price to book. This compares to the regional average of about 1.7 times price to book. So there you can see how much premium we are already ascribing to their growth. I think going forward, we need to see, the corporate earnings growth really growing into those multiples. Otherwise, there'll be some disappointment.
It's the long-term growth potential, though, I think, what's been really exciting investors, right? Especially if you compare it to China. What do you think of those two markets vis-a-vis each other?
Yes, again, we totally understand the positive sentiment towards India. We've seen a lot of difficulties in China in terms of the policy headwinds as well as the property market decline. But again, going back to valuations, China is now trading at a very, very low multiple compared to the region, compared to India. And I think there is an opportunity there for selecting the right companies in the right sectors, and there's still plenty of alpha generation.
When are we going to see that turnaround, especially in the economy? Because the economic data has been pretty mixed, right?
Yeah. So the most recent property policy that came out of the officials, that's very encouraging in that it's finally starting to address the inventory issue in the Chinese property sector. We hope that it does put a floor to the property decline and then gradually restore confidence in consumers. We haven't seen that happen yet, but that's our hope.
And that will translate into equities getting a boost, because right now that flight to safety is just pushing that bond rally to incredible levels in China right now.
Yes, exactly. We're not expecting a overall strong recovery as we've seen in the past. I think it will be more selective. But some companies are really coming through with impressive improvements in their cost structure, in their corporate governance structure, and these would be the opportunities for China going forward.
Ansa Goshi, really good to see you in person here in the Tokyo studio. She's the equities portfolio manager at JP Morgan Asset Management. And of course, we've been talking about those chip makers, about the tech rally. Take a look at how Asian names are trading at the moment. We are seeing the sea of green gains of more than 2% for most of those chip makers after we saw that incredible rally in the Wall Street session. Magnificent 7 stocks contributing more than 60% to the S&P 500's return this year. So not surprising, the S&P 500 seeing its 31st all-time high of 2024. And of course, you can see what Nvidia has been doing so far, and it's now topped the market cap of that of Apple and Microsoft and has become the world's largest company. Gains of about 3% or more in the previous session, sending the market cap about $3.3 trillion total on Tuesday, which is also making CEO Jensen Huang very rich. Go to Rich Go is your Bloomberg terminal function to check that out. More ahead on the Asia trade. This is Bloomberg. You're watching the Asia trade. We're following geopolitics because Chinese Premier Li Qiang has finally arrived in Malaysia for a 3-day visit. Let's get more on this with Bloomberg's Avril Hong in Singapore. Of course, the Premier has been pretty busy. We've talked about New Zealand, Australia, now in Malaysia. How significant is this visit?
Indeed. I mean, Malaysia is just the next leg of Premier Li Qiang's tour, in a way, of the Asia Pacific, right? And this is actually the first time since 2015 that a Chinese premier is landing on Malaysian soil. And I think the significance comes in that this is at a time when Beijing is courting these smaller nations that have made quite clear that they are neutral amid the US-China rivalry. So that's what's at stake for China, for Malaysia, I think, is a way to deepen ties with China, its largest trading partner. We've seen its economic recovery in the most recent quarter accelerating, but the economy could still really use a boost. And, I think the Malaysian leader has also made some headway in terms of its own chip industry, kind of bolstering investments in that sector. But this trip, I think, is a way for it to position Malaysia as a destination for investment from both the US as well as China. I mean, you just think about how in recent times Malaysia has announced investments from, Chinese as well as American companies such as ByteDance, Google, Microsoft. And this is coming despite some of these disagreements that Malaysia has with Beijing. It's over the South China Sea, and with Washington, it's over its handling of the Israel-Hamas conflict. So clearly here, it's Malaysia trying to prioritize its business interests.
Does that mean that what we're going to get are mostly economic deliverables? What can we expect from this trip?
Yeah, I think there's going to be more in the way of economic cooperation between Malaysia and China. I mean, just a day ago, we heard ahead of the visit, Anwar talking about how Malaysia plans to join the BRICS economic bloc. And we're also waiting to see Lee potentially at this groundbreaking ceremony of the East Coast railing. This is an $11 billion project that is part of China's Belt and Road Initiative. And this is worth noting because it's a project that has seen suspensions and then resumptions after renegotiations, which saw a significant bring down of the costs involved. And I think this is, in a way, Lee being at this groundbreaking, highly significant. In terms of some of the other things that we can expect, we are waiting to hear on some of the MOUs, as well as the renewal of an economic and trade pact between the two countries that, will go some ways in deepening links in some of the industries such as robotics. Shery.
Right, Bloomberg's Avril Hong there with what to expect from Premier Lee's visit to Malaysia. As we continue to see this very polarized security environment in Asia. Russian President Vladimir Putin now arriving for his first visit to North Korea in 24 years. He praised Kim Jong-un's regime for its support of his war in Ukraine. Our East Asia government editor John Herskovitz joins us now here with the latest. So it was a very warm welcome that he received at the airport by Kim Jong-un.
Yeah, it was. You had the hugs, you had the cameras going. It was a show of the close relations between the two, which have gotten much closer since the full-scale invasion of Ukraine began. Russia's an isolated country. North Korea's an isolated country. Kim and Putin have found each other to be even better friends than before, as they've been plunged deeper into international isolation.
Because you would expect Pyongyang to be more aligned with Beijing, which has been its ally and partner for decades. But now you're seeing China very preoccupied with other smaller countries, and yet North Korea is now having this sort of, can I call it a bromance with Vladimir Putin at this point?
Yeah, exactly. There was actually, Putin gifted Kim Jong-un a luxury Russian limousine after they met in September. But the thing that North Korea has that Russia wants is weaponry. North Korea has some of the biggest stocks of Soviet-era weaponry in the world. It has artillery shells that are comparable to what Russia has on the front lines of Ukraine. It has spare parts for old tanks that Russia is taking out and using. It has the most of things that Russia needs because they were military partners for so long. And North Korea has one of the world's largest militaries.
In the meantime, Kim Jong-un gets, legitimacy, gets aid from Russia?
He's getting a few things. He's getting commodities, he's getting technology, he's getting military help. Like with the commodities, he's getting enough food that food prices have been a little bit more stable in his country. The technology is helping him with things like trying to launch spy satellites, and the military technology is the most worrying thing. The more he gets, the more potent his military becomes, the more of a threat it is for Japan, South Korea, and the U.S.
Anytime we talked about North Korean missile launches and provocations that we've seen from Pyongyang, we always thought it was a headache for Beijing because Beijing still wants to advance its economic interests with other partners. How does this play out for Chinese leaders?
Well, I think that North Korea now is really operating much more independently from China with its missile program and its nuclear program. What it's doing is just trying to develop the ability to deliver a capable nuclear first strike and a retaliatory strike. It's not seeking a green light from Beijing or from Russia. This is what North Korea is doing. Like some things that used to really coincide with political events for launches, now they're doing it, for the most part, on their own schedule. It's Kim's program, and what's happening with his powerful neighbors is not as important as it once was.
What about the neighbor to the south, South Korea? Not to mention, of course, Washington and how it plays into the Biden administration strategy for Asia.
Exactly. The more that aid that North Korea gets from Russia, the less it needs to go to the nuclear talks. The nuclear talks are disarmament for help with the economy. If Russia's providing the help, the incentive to go to the nuclear talks becomes less and less. Kim has refused the invitations for the talks. The more help he gets from Russia, the easier it is for him just to stay away from the table, not engage with Washington, not engage with South Korea, not engage with Japan.
John Herskovich, great to get the context from you. He's our government editor of East Asia, and of course, we're following that Russian president visit to North Korea. And this is how European futures are trading at the open across Asia right now, because of course, we've been following the political volatility across Europe. We had seen French stocks lose about $200 billion in value last week. We're seeing the Euro Stocks 50 futures to the upside of 0.2%. Of course, we have plenty to contest with this week. A BOE rate decision, the Swiss National Bank, Norway's Norges Bank also deciding on rates at a time when investors are still steering clear of French government bonds. Remember, we have seen that spotlight return to France's stretched public finances. And we will continue to watch where the European Commission goes when it comes to that ruling on the French deficit on Wednesday as well. This is Bloomberg.
I believe economic conditions are indeed moving in the right direction. If the economy evolves as I expect, it would become appropriate to begin easing policy sometime later this year.
I will need to observe a period of favorable inflation, moderating demand, and expanding supply before becoming confident that a reduction in the target range for the federal funds rate is appropriate. These conditions could take months and more likely quarters to play out.
We have to let the data tell us, and it's not one or two indicators. It's looking more holistically at the information.
Are you looking at one or two rate cuts at this point, given where things are?
I could imagine scenarios that would be consistent with both.
The latest commentary from Fed officials on the likely timing of rate cuts. Let's get to some of the market calls that we're following today, because traders are also piling into bets for surge in U.S. Treasuries. That's as they re-enter a bullish trade. They fled in the run-up to last week's inflation data and Fed decision. JP Morgan saying the momentum is also building in the cash market as its recent Treasury client survey signaled the largest net long bets in about a month. Investors have cheered ebbing price pressure and weak retail sales that boost the case for lower rates. Economists at Goldman Sachs say that the U.S. labor market stands at a potential inflection point. They believe any further softness in demand for workers will hit jobs and not just job openings. They say the current strength of labor demand in the U.S. remains unclear, with healthy non-farm payrolls contrasting with rising initial and continuing jobless claims in recent weeks. Take a look at U.S. Treasury futures trading at the moment. The cash market closed as we are seeing a holiday in the U.S. But we had seen bonds climbing in the previous session on the sale of a 20-year Treasury. So the 10-year yield was falling towards that 4.20 level. And we were talking about that economic picture for the U.S. A little bit mixed. I mentioned retail sales barely rising 0.1% month on month. The previous months also being revised lower, while we had industrial production numbers actually doing better, increasing and really being helped by a broad-based pickup in factory output. Here in Japan, we're following the latest developments coming from Norinchukin Bank, saying that it plans to sell around $63 billion in U.S. and European sovereign bonds to halt the bleeding from wrong-way bets on interest rates. The agricultural lender has confirmed it's now facing a full-year net loss of almost $10 billion. That's triple its previous forecast. For more, let's bring in Asia investing editor Russell Ward. Russell, of course, what's catching our eye, because we had been sort of expecting the losses to happen, is just the sheer size of it.
That's right. Norinchukin flagged a month ago that it is going to sell a lot of foreign bonds because it's been stuck with these bonds on its balance sheet while its funding costs have risen. So it decided, we're going to basically kitchen sink all of these bonds, these unrealized losses. We'll crystallize these losses and then clean up the balance sheet going forward. What's new is that the CEO, in an interview with the Nikkei yesterday, has come out with an actual figure for the bond sales, and that's 10 trillion yen. With the bonds. That's a lot of bonds that they're going to be selling over the next year. And that means that the losses that they are predicted less than a month ago are actually, they're estimating to be like triple what they estimated. So that's quite a surprising sort of, revelation less than a month after the initial disclosure.
And also what was really interesting for me that caught my eye was that this bank was basically trying to diversify away from the domestic market because of the negative rate situation, low rate situation. And yet now they're facing this conundrum. Are there any other banks in Japan that could face a similar fate?
Yeah, I mean, that's right. I think all Japanese investors, banks, insurers and others have been looking overseas for more yield. I think regarding the other banks, I think it's fair to point out that Norinchukin is quite unique. They're quite different from other banks. They don't really lend money. They don't really do investment banking. They're sort of more like an investor. And so the biggest Japanese banks, the mega banks, they have very diverse business models, very sophisticated portfolio management, and they've been managing their bond portfolios. So they've been selling a little bit, and they have a little bit more ability to hold on to these bonds until they mature. So I think analysts are sort of saying that at this point they're not really expecting any kind of contagion effect or any sort of systemic issues here.
How did we get to $10 billion, like triple what was announced just a month ago?
Yeah, I mean, this is the big question. The CEO sort of just came out in this interview with the Nikkei and said this. So we're sort of trying to get to the bottom of that ourselves. Nevertheless, it was flagged a month ago that these losses would be enormous. And then one of the questions, I think, is, how are they going to sell these bonds over the coming year? Is it going to be all in one go? You would hope not if you're in the bond market. Or will it be gradual? And then the next question is, where are they going to invest next? Norinchukin is also a big investor in CLOs, collateralized loan obligations. Right. So that could be one avenue. JGBs may be attractive too, with coupons rising there.
Russell Warren, our Asia investing editor, watching the latest when it comes to potential volatility in the bond markets. But check Mitsubishi Motors right now, because that stock is surging. We have now seen a report that the company plans to increase shareholder returns this fiscal year, according to a report by Nikkei that's sending the stock higher. This is Bloomberg. We're about 30 minutes into trading in Asia. The top stories that you should know right now. Asian stocks posting early gains after a rally in chip makers drove U.S. stocks to a fresh record high. Chips and the AI boom in focus, with Nvidia surging past Microsoft to become the world's most valuable company. Russian President Vladimir Putin has arrived in North Korea for his first visit in 24 years after praising Kim Jong-un's regime for its support of his war in Ukraine. Kim personally greeted and hugged Putin as North Korea media hailed a new phase in relations. And Chinese Premier Li Qiang is in Malaysia now for a 3-day visit. The trip comes as Prime Minister Anwar Ibrahim says Malaysia will join the BRICS economic bloc, an expanding group seen challenging the Western-led global order. Now, Premier Li's visit to Australia earlier this week reflected a warming of ties, but also exposed the gulf between Beijing and Canberra over issues including critical minerals. Our next guest says the relationship is becoming more complex as China grows. Joining us now is Jeff Raby, chairman at Business Advisory. Jeff Raby and Associates, who previously served as the Australian ambassador to China. Ambassador, great to have you with us. Just give us your take about Premier Li's visit to Australia and what's been achieved.
Well, first of all, I think it's put the relationship back on a more normal footing. This is the first high-level visit from China in 7 years, and that's quite extraordinary. For 40 years before that, each year there were reciprocal high-level visits. Our Prime Minister went to China late last year, and now Li Qiang has come this year. So I think it's fair enough to say that the relationship's back on a normal track with annual high-level visits. Our Prime Minister described the visit as having refreshed and renewed the relationship after half a dozen or more years of great difficulty, and I think that's not a bad assessment of the visit.
The two nations really trying to increase economic cooperation, but one episode that went viral during this trip was Chinese officials trying to block journalist and former detainee Cheng Lei in a ceremony in Canberra. I wonder how close can these two nations get when they clash on fundamental issues, ideology, human rights, even when the economic interests are there?
Yeah, no, exactly right. And I think no one wants to shy away from the major differences that divide Australia and China. But I mean, that's true with China and any other country in the West. And Australia has large differences with countries, say, like Vietnam, which also has a poor human rights record run by a one-party authoritarian communist state, just like China. The challenge for Australia is as the global competition between the US and China intensifies, we're able to navigate between a very difficult space, being true to our values and interests, but at the same time, maintaining as good and productive relations as we can with China. Look, you know, I said we haven't had a high-level visit in 7 years. In that time, China has gone from 60% of US GDP to having a GDP equivalent to 3/4, 75% of US GDP. We're living in the middle of one of the greatest power shifts that's ever occurred in human history.
And yet you do not want cooperation when it comes to sensitive industries like critical minerals. How big of a sore point will this become?
Well, I don't think it's a sore point if we are open and transparent about our policies. There are many sectors in China that are closed to foreign investment. And that's made clear, and it's the same with critical minerals in Australia. If we define critical minerals as being of strategic interest to Australia and of importance, then we need to be clear and upfront that they're not open to foreign investment. I think the main thing is that we do this in a transparent and non-discriminatory way.
We are now seeing Premier Li in Malaysia trying to court smaller, more neutral nations. We have heard from Malaysia that they will actually be joining the BRICS economic bloc. Are we seeing a more polarized security environment? And as this progresses, how difficult will really the role, the position be for some of these nations like Australia?
Well, I think with Malaysia, it's very interesting news that's just come in. I'm just getting across it myself, but it doesn't surprise me because what we're seeing in this new multipolar world is a bifurcation into two major orders. There is a US Western-led order, which Australia unashamedly has placed itself in that group, and there is the Chinese-led order. And it's very interesting that Malaysia has decided to join the BRICS because this really is part of the institutional framework that China's put in place to give definition and structure to its order, along with the Belt and Road Initiative and the Asia Infrastructure Investment Bank and so on.
And how do nations like Russia and North Korea play into that? Because we have Putin now visiting Pyongyang in what seems to be a potential realignment by Pyongyang towards Russia more than China even.
Yeah, I think you really put your finger on it. This is a three-party dance that's going on. And it's interesting that the North Korean leader visited Russia last year and met with Putin, and Putin's now made a return visit to Pyongyang this year. This is very much a lot of messaging about China as well as to the West. Sure, it's showing the West that Putin has other friends and other options. Sure, Putin needs Pyongyang's support in the war in Ukraine, particularly with respect to ammunition. But equally, it's a message to China that Russia has options, because one of the big things that's happened since Putin's invasion of Ukraine is that in many ways Russia's become the junior partner in the China-Russia relationship. And I think this is a very uncomfortable place for Russia to be occupying.
Uncomfortable also when it comes to Washington and its allies. We know that they've really been trying to deal with the situation in Ukraine. They've been trying to also rein in China's chip ambitions. They're dealing with a lot on their plate. How will they collaborate with allies across Asia in order to push back against this?
Well, look, there's the sanctions regime, and I think that's pretty much in place. Probably can't do much more than that. But I think the key thing here is for the West not to assume that we have some sort of axis of authoritarian states or axis of autocracies. I call this the Chasha illusion. Anxiety, rather. China and Russia creating anxiety in the West that there's a bloc lined up against them. Sure, both Russia and China have shared ambitions and objectives to recast the international order. Sure, they both have difficult relations with the United States, but their interests are quite fundamentally different. And I think a key part of this will be how well the United States can keep engaging with China and to provide alternatives to China and Russia.
Ambassador, really great catching up with you as always. Jeff Raby, former Australian ambassador to China, with his views about the geopolitical realignment perhaps that we're seeing across the region. And this, of course, as we keep an eye on Washington, the Biden administration sending an envoy to Japan and the Netherlands, seeking greater cooperation in limiting China's AI chip ambitions. For more, let's bring in our chief North Asia correspondent, Stephen Engel. Steve, why do they feel the need to do this?
Well, obviously, the Biden administration has launched these export controls on most advanced tech to China. They want to get on board the allies that also make the key equipment. We're talking about ASML, which makes those extreme ultraviolet lithography machines, pretty much the only one that makes specific machinery for these AI accelerators that are powering, artificial intelligence. And then also, of course, Tokyo Electron in Japan. So there's been several rounds of these export controls, but now we're seeing, more efforts by the Biden administration to get these countries to use their influence on those key companies like ASML and Tokyo Electron to go even further. In particular, the servicing of these multi-million dollar machines, because again, these machines need constant servicing, and it's a constant form of revenue, of course, for ASML as well as for Tokyo Electron. So Alan Estevez, who's the Undersecretary of Commerce for Industry and Trade, will be heading, according to sources, probably in the first week of July, to Holland as well as Tokyo to talk to the government and really urge them as well to make sure that the key suppliers to the AI chip industry in the West, not to China, comply or can be on board with further restrictions that the Biden administration might come up with. Again, it's also focusing, it gets a little bit technical, but they're also focusing on the servicing and the selling of HBM, which is the high bandwidth machines for the high bandwidth memory chips, which are critical. And you can't have a AI accelerator without those HBM chips, memory chips. So again, this particular focus of Mr. Estevez is to get those restrictions on board for those particular AI chips, HBM, which the Chinese have made strides making with its own domestic chip makers, including Huawei.
You know, so difficult to find consensus in Washington, but when it comes to pushing back against China, it seems even U.S. lawmakers are on board. There's new legislation that could further limit China's semiconductor industry.
Yeah, well, this one sort of makes sense if you understand the Biden administration and also Congress's attempts, of course, to curb Chinese rise in its own advanced chips. Now, of course, in 2022, we had the Chips and Science Act, which basically is going to dole out tens and tens of billions of dollars, upward $40 billion, plus other grants to companies that build domestically chip facilities. So TSMC is building those facilities, for example, in Arizona. Now, this new legislation was introduced in Congress on Tuesday, essentially will forbid, if it is passed into law, will forbid any chip maker that takes money from the Chips and Science Act and builds in the United States will forbid them from using Chinese-made chip gear in those facilities. It would not necessarily restrict a TSMC, for example, to use Chinese-made gear in their Taiwan plants or in their Kumamoto, Japan plants or in Europe ambitions and the like. But in the United States, if you're going to take federal money to build a chip plant in the United States, you would not be able to use any Chinese-made gear in those plants if this law is passed.
Our Chief North Asia correspondent Stephen Engel there with the latest on those restrictions against China. But take a look at how we're trading across markets in Asia, because we're seeing that huge tech rally that we saw overnight on Wall Street carrying through in the Nikkei and the Kospi. We're talking about tech being one of the biggest gainers in today's session. The likes of Samsung, SK Hynix, the big movers on the Kospi. Also, when it comes to the Nikkei, communication services and information tech, some of the big movers. And of course, not surprising, perhaps also because we have seen those export numbers out of Japan, pretty strong growth by the most since 2022. Of course, for the case of Japan, a weak yen is also helping. Not a lot of movement on the ASX 200 at the moment. Of course, the RBA has kept rates steady at that 12-year high, but policymakers discussed the case for a rate hike, not a cut. So perhaps that's still being digested in the markets. This is Bloomberg. Take a look at how sovereign bonds are trading across Asia right now. A little bit of a mixed picture after we had the RBA holding rates steady. Bond yields rose initially. Take a look at the Australia 10-year yield at that 4.14 level after the RBA kept rates steady. But Governor Bullock said that they discussed a rate hike, not a cut. So that's being digested by markets. Not to mention that we have cash treasuries closed today. We are headed towards a U.S. holiday. In the previous session, we had treasuries climbing a little bit on a sale of a 20-year treasury auction. The 10-year yield was falling towards that 4.21 level. And we're watching 10-year JGB yields as well, still below that 1% level. Of course, we're still digesting what happened at the BOJ policy decision last week and Governor Ueda's comments in Parliament as well yesterday, where he kept the door open to a possible rate hike in July, even when done together with cuts in debt purchases. But why are we taking a look at the broader sovereign bond space across Asia? Because we're very much focusing on what's happening in China. Sovereign bond futures closing again at a record high. This buying frenzy rolling on despite warnings from authorities. For more, we're joined by our China correspondent, Min Lo. Min, so this bull run just doesn't want to end. What's driving it?
Yeah, Chinese government bonds have just been on an absolute tear this year. We're seeing those futures on the 10-year note yesterday hitting above 104. That's really the highest we've seen since all the way back in 2015. And those yields as well reaching a 2-decade low. And some analysts believe that it can go down even further, reaching maybe 2.18% by the end of the year, down from the current 2.25%. Now, this really signals that investors are flocking to this haven assets, given weak confidence in the macroeconomic recovery. We've seen mixed data coming out so far. Big disappointment on Monday on those home prices, which are still extending declines despite government efforts to boost that sector. And so there is speculative trading from retail investors as well as corporates who are looking for higher yields beyond your regular bank deposits. And traders are also betting on more stimulus that could weigh on yields. But of course, the PBOC has been resisting market calls for a rate cut. They have been keeping the MLF rate steady since August of last year amid fears of depreciation of the yuan. And then also you have these foreign buyers of Chinese debt that has reached record levels last month. They're really cashing in on this interest rate differential between US and China to lock in those higher currency hedged yields.
And Chinese authorities are not happy. They've been warning of potential action. Could we see something?
Yeah, the PBOC has repeatedly warned of a possible bond bubble that's brewing, and if it bursts, it could really destabilize financial markets and derail economic recovery. And the big fear is over leveraged bond buying, which amplifies volatility, and that's really what we saw last year in the U.S. with the collapse of the Silicon Valley Bank. So the PBOC has warned that it's not sustainable to see those gains that are as high as over 10% for some this year so far. They're saying that investors are underestimating factors like inflation, which could upend those rallies. So the PBOC has been giving some verbal guidance, if you will, through the newspaper that it backs, saying that these yields should really stay at between 2.5% to 3%, and hoping that the market will correct itself. But if not, the PBOC could step in to sell these bonds to cool the markets, and that could really mark an end to a 17-year hiatus from the central bank refraining to step into the secondary bond market. And certainly there's many things not to like about the low yields because it puts further pressure on the yuan, which the PBOC has already been trying to prop up. It also means that monetary stimulus is not breaking through to the real economy through higher credit that could lift spending and investment. And that's precisely what Premier Lee had warned about. He said he is vowing against these funds that are sitting idle and just circulating in the financial markets.
Bloomberg's China correspondent Min Lo there with the latest on China. And of course, we continue to watch the economy. One of the big consumers when it comes to some of those metals, and not to mention oil as well. We are seeing copper rebounding slightly, but this after dropping below 9,500 a ton in the London session. We saw stockpiles jumping by the most in 9 months. That demand picture, not only from China concern, but also deliveries into warehouses in South Korea and Taiwan have taken a hit. So we saw a little bit of volatility in copper prices, not to mention iron prices as well. Iron ore gaining 2% in the Singapore trading session. But Brent crude not doing much this after WTI closed at a 7-week high. That risk-on mood across assets being reflected in oil prices. This is Bloomberg. You're watching the Asia Trade. Citigroup is putting its services business in the spotlight as a key component of the lender's restructuring and profitability plans. CFO Mark Mason told us exclusively about the division's potential.
We want to be the preeminent bank for institutions with global needs, as well as a leader in global wealth and a winner in the U.S. market for our personal banking business. That's what we are today, all right? And a lot of what we talked about today, again, was really highlighting the crown jewel of our firm, the gateway to the rest of our offering for large institutional clients, but also for middle market clients, as well as for investors and asset managers in both that Treasury and Trade Solutions business and our security services business.
It's interesting because, to your point, even though securities services has been a crown jewel, accounting for roughly half the profit recently of Citigroup's own entire businesses, it's been hard to explain to investors exactly what it is, what it does. Do you think Citigroup stock would be trading higher if people understood the business prospects for it?
I think the services businesses, which are comprised of that Treasury and Trade Solutions and the security services business, contribute a significant amount of value to this franchise. And I hope that after today, investors will realize exactly how much value that is and how much upside there is to that franchise, and we start to see it in the stock price.
Today, you are seeing it in the stock price. If you think about some of the things that have been holding Citigroup behind, Mike Mayo of Wells Fargo, big proponent of Citigroup stock, but even he has been kind of critical here of the wealth business, calling the returns pitifully low. The question is, do you have a timeline for when investors can expect returns in that business, and how soon and how robust those returns can be?
You know, one of the things we talked about today is timeline. We talked about the medium term, 2026. We talked about top line growth of 4 to 5%. And we talked about the services businesses being a significant contributor to that, both in the top line and our services businesses, a 20% return on tangible common equity. In the wealth space, we brought in new management there. And we're keenly focused on how we grow the top line and how we improve margins and how we improve returns there. That's going to involve everything from right-sizing the cost structure to increasing the banker productivity to driving new net investment assets across that business. And we do believe that inside of this window between now and 2026, you'll start to see that value play through our financials.
Citigroup CFO Mark Mason speaking exclusively with Bloomberg's Shonali Basak. Now, this is the setup for the market opens in China. U.S. futures not doing much after the S&P 500 reached another record high, its 31st for the year. Of course, that tech rally driving those gains. We continue to see that tech rally translate into the Asian session in the Nikkei and the Kospi gains as well. But of course, we'll be watching the China Open, especially what happens to that bond rally that's taken the 10-year yield to the lowest level in more than 2 decades, as we have Premier Lee now in Malaysia continuing his tour of Asia. That's it from the Asia trade. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai, and Shenzhen. The China Show is next. This is Bloomberg.